Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. Great to have everyone back on the YouTube series, back on the Robinhood portfolio. For today's video, just want to do a quick update on the portfolio and then talk about something that I've been fearing for the last couple weeks, something that I have been trying to avoid with my options contracts. I had a few contracts get assigned early. They were called away, meaning I had to sell off stocks in the portfolio, stocks that I was doing covered calls with. They are no longer in the portfolio, and I had to sell the stock off for way less than the current price of the stock. But that is a risk, which we'll talk about in today's video. Before we do that, let's go ahead and take a look at the portfolio. As you can see here up on screen, very strong day of performance, up 1.08%, $6,061. But a rather turbulent day. Early morning trading here, pre-market down almost $9,000 before rebounding here to $10,000, $11,000. Early morning trading, again dropping almost $20,200, $20,168 in the red before rebounding here in afternoon trading, and then after market trading as well. Again, ending the day 1.08%, $6,068 in the green. If we scroll down to the options contracts, this is really what I want to emphasize on today's video. You can see on the bottom of the screen, Ford $13 call, 12/16 expiration date, 229 cells. These are the Ford contracts that I rolled out and up, meaning I rolled from a strike price that was at $12 to a strike price of $13, so rolling up, and then as well rolling from August 5th out to December 16th, rolling out. So rolling out and rolling up with these contracts. But I only did that with 229 contracts. If you remember from yesterday's video, I had 240 contracts. 11 contracts, 1,100 shares were called away. Again, meaning I had to sell off at the prior strike price of $12. If we go over to Ford, you can see another very strong day with Ford Motor Company, up 6.07% in active hours trading, another 0.93% in active hours trading. So 7% in the green. 1 week you can see 7.79%. 1 month up 21.88%. So it's been rebounding quite nicely, which is a double-edged sword when you have covered calls. Yes, the stocks you have in the portfolio are gaining value, capital appreciation, but you also have the risk that these will be assigned early and selling off for a much lower price of your strike price. In the middle, 22,900 shares. Yesterday, 24,000 shares. If we go down to the history, we'll see exactly where I had this assignment occur. Into history, you can see in the middle of the screen, Ford $12 call assignment. So I had to sell off. This was done automatically at $12. 11 contracts on the bottom of the screen. I sold 1,100 shares at $12 per share. And if we click on that button up on the top, you can see on Robinhood it goes through exactly what's going on. Expiration, exercise, assignment. Because I was doing a covered call, these were assigned to the portfolio. If we take a look at that top banner here, if you're assigned on a covered call, you can see the shares you have on collateral should be sold to settle the assignment. No additional action should be necessary. This was done all automatically. So the buyer of the call has the option at any point before the end of the expiration date to assign these early. Typically, they do not assign these early for a variety of reasons, trying to limit their risk, saving their cash, and not missing out on what's called time value. I won't go into too much in depth on these metrics, but essentially the premium I get on selling these stocks is intrinsic value plus what's called time value. It gets a little bit complicated, but if there's a potential dividend in the mix, if you're selling off covered calls with stocks that have dividends, before the ex-dividend date, they may be assigned early. It gets, again, very complicated, but if the upcoming dividend amount is higher than the time value remaining in the call's price, it may make sense for the buyer of the option to exercise those early, to assign those and have those shares called away from your portfolio. Again, don't want to get too complicated with that, but I made a mistake. I should have rolled out and up. I did not do that. I had rolled from $7.29 to $8.5, $12 to $12. Unfortunately, they were assigned. And because I do not want additional contracts being called away, being exercised by the call buyer, being called away from my portfolio, I went ahead and rolled out to December 16th, up $1 to $13. So a risk in the portfolio. I hope that does not happen moving forward here, but that can happen at any point. And again, in the hundreds, thousands of contracts that I've done with options trading, only a handful have been called away. And it's typically after the price of a stock starts shooting up quite dramatically. And I don't do enough of rolling out and rolling up to prevent that from occurring. But again, just wanted to quickly go through the portfolio, updating you guys on today's performance, as well as that unfortunate call assignment with Ford Motor Company. With that, I'll end the video. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. To the next video, we'll see you then.